Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, Head of Fixed Income Strategy at Wisdom Tree Asset Management. And I'm pleased to have a very special guest today. We have with us Vishwanath Tirupattur, the Chief Fixed Income Strategist at Morgan Stanley. Vishy, great to have you on.
Thanks for having me on, Kevin. Look forward to chatting.
So, what a great kind of analyst to have on, strategist, with all that's going on in the fixed income markets. There's been just a incredible outpouring of demand headlines on the private credit front. And I wanted to address that. I wanted to give our listeners a little bit of a sense and perspective. What are we talking about here? So a lot of people may be familiar with public credit, right? High yield bonds, investment grade corporate bonds, things like that. And when they hear private credit, they go, oh, okay, private credit. Vishy, I was hoping you could just give us like a sentence or two. How would you differentiate for our listeners public credit and private credit?
It's a very good question, Kevin. Private credit is rather an umbrella term that can encompass a wide range of strategies. But I think maybe best place to start off is what we'll consider direct lending strategies. And in this context, I would define private credit as debt extended by non-bank lenders to corporate borrowers either on a bilateral basis or with using a small number of lenders. So the lenders originate and negotiate terms directly with borrowers, as opposed to the public debt markets, where all of this happens through a public syndication process. So no syndication, typically not much syndication at all, is involved in the context of private credit. These are not publicly traded on public markets, and typically they have no rating agency ratings. Sometimes they may have a private rating but not visible publicly. And since they're not publicly traded, there are not public marks, or since they're not publicly traded, there is no transparency in terms of their mark-to-market values. So the reliance is on third-party valuations. On the other hand, there are significantly higher amount of lender protections, stronger loan documentation, and stronger overall creditor protections in the context of direct lending.
That's great. And you all and your team put out a report to begin this year, The Road Ahead for Private Credit in 2025, and provide regular kind of updates. And I just wanted to, get your take, ask you, one of your key takeaways was talking about, how improved funding conditions have led to intense competition between public and private credit. I was wondering if you could give us a little bit more of a sense of what you're referring to there.
Right. Public credit and private credit, we would argue that both compete with each other. They also complement each other. So, and both the effect of the competition and the complementarity have their own broader effects on the credit markets at large. So let me talk about the competitive portion between public and private credit. So if I think maybe better to step back a couple of years and see how this competition dynamics have really evolved. So if you go back to, say, 2022, 2023, the public credit markets if you go back to 22, 23, there was a significant amount of macroeconomic uncertainty. If you recall, Fed was hiking rates. It was unclear when Fed would be done hiking rates. That kind of a macroeconomic uncertainty created a fair amount of uncertainty about execution of deals in the public markets through the broadly syndicated loan markets and the broadly syndicated markets in general. So this is where private credit lenders stepped in, non-bank lenders stepped in, and not having to deal with a large number of borrowers, which would be the case in a syndicated, broadly syndicated loan process. Instead, you're dealing with a small number of lenders, sometimes just one lender, maybe one or two lenders, and the terms are negotiated much more directly. So in this period, we actually saw private credit take a significant amount of share from the public markets. Come 2024, a lot of the macroeconomic uncertainty came down. The Fed clearly the Fed made it clear that they're done hiking, that they may start cutting, and we have seen indeed that they cut rates by about 100 basis points since then. And the public markets actually came back fairly robustly. So as the public markets came back robustly, you saw some of the deals that were refinanced in the private credit markets went back to the public markets. So that when the certainty of execution got better in the public markets, private credit markets gave up some of that market share. But over the course of 2024, we also saw sort of a private and the public credit markets finding their own lane. So what do I mean by that? The public markets ended up being larger deal sizes, deals that are credit deals that are more commoditized capital structures ended up going back to the public markets. And in the private credit markets, deals that are more complicated deals, more have more hair on them, that type of deals, and perhaps deals that are for which there is not a strong bid from the public markets, either because the deals are too small in size or because these are some of the distressed transactions. So names that are rated single B minus on a negative watch or a triple C rated already downgraded to triple C. That type of borrowers ended up staying in the private credit. So net result of this is that the competition ended up convergence of So the net result of this is where the public and the private markets were competing, there's a bit of convergence in the pricing in terms of spreads, also in terms of the quality of the covenants. On the other hand, in smaller deals, in deals that have some more distress associated with them, there was much less of this spread compression and covenant quality give up was much more in the smaller deals where private credit specialized. We didn't find this kind of a give up by private credit in terms of covenant quality and in terms of pricing. So, but the complementarity steps in here because private credit created an avenue for loans that would otherwise, in the public markets, there was no exit. So private credit for those names that are distressed, say B minus negative watch or a triple C loans, because there is not a really strong public market bid, private lenders have stepped in. And in a way, this has helped smooth the default curve evolution. So this is what I call complementarity in the overall credit markets. So public and private, significant dynamics, evolving dynamics, and finding their own lanes, competing as well as complementing each other.
That's fascinating stuff. I think a lot of aspects to this that investors don't quite think of sometimes. And looking here at the road ahead, to use your term, for 2025, what about the fundamentals? And obviously everyone, when you talk about fundamentals and credit, the D word, defaults, come up. So what are our thoughts, or I should say, what are your thoughts on that part of the equation?
So on the fundamental side, we should keep in mind the credit quality of the loans that are in these private credit deals are on the lower end of the credit spectrum. So if you take the credit metrics such as debt to EBITDA, leverage metrics like debt to EBITDA, or interest coverage metrics, you'll find that the average quality of the loans in the private credit markets tended to be something in the rough equivalent public credit terms, B minus to triple C type of loans. So credit quality wise, that's how you would map the private into public. Now, if you start looking at what's happening to these metrics within the private credit markets, and basically we find that the leverage has relatively stabilized. The trends in interest coverage have somewhat improved, and we think that from a default perspective, measuring defaults in private credit is much more complicated than measuring defaults in the public markets because there are various definitions. There's not a uniformity of definition. What constitutes a default is not, different sources of data use different approaches to defining what is a default. But taking all that and into account and taking a wide range of definitions and data sources into account, we think that the private credit and public credit defaults are somewhat converging. So we don't find any evidence that the defaults in the private credit markets are substantially different to what is being experienced in the public credit markets. And then you layer on top of this our expectations of earnings growth, our expectations are in terms of the underlying credit fundamentals. We expect that the earnings growth will be meaningful and positive for the companies that are borrowers here. And you layered on top of that interest coverage ratios that are on the margin improving, and leverage ratios that are not anymore deteriorating anymore. Leverage ratios that are relatively stable. Expectations for defaults are fairly benign. So we think that we'll see default rates stabilize kind of in the 3 to 4% type of range, and stabilize in that level is within the private credit markets. Not that much different than what we expect in the public credit markets.
Got it. So final question for me then, just taking it to I think the last step in the process. How about total returns? What are we expecting in private credit for this year as, say, compared to what you may be expecting on the public side?
Our basic expectation is that the private credit has a certain illiquidity premium that is built into it. And this illiquidity premium is reflected in a spread to the public markets. So we think that there is going to be some amount of compression between public and private markets, that spread premium. Still, we expect a fairly healthy total returns in private credit, somewhere in the range of 8.5% to 10% over the course of 2025 is our expectation. That will be about 1 to 2 percentage points on top of our expectation for public broadly syndicated loans.
That's great, Vishy. I think we're gonna end it there. I hope for everybody out there listening that you've gained some educational type of qualities on the private credit front, because I know from our vantage point on the ETF side of the equation and the headlines you're seeing there, it's just seeing just an incredible wave of demand for private credit out there and ways and solutions to take advantage of it. So Vishy, once again, thanks for coming on. Hopefully I can have you on again in the future as a follow-up.
Thanks for having me, Kevin. I would love to come back.
Sounds great. All right, everybody, take care and have a great rest of the week.